Next, we will discuss the topic Global Trends in Alternative Investment and Outlook. We will listen to a very fine presentation by Jiří Król, Deputy CEO of AIMA. Jiří Król is the Deputy CEO and Global Head of Government Affairs at AIMA, the Alternative Investment Management Association based in London. Jiří joined AIMA in April 2010 and is Deputy CEO and Global Head of Government Affairs. Prior to joining AIMA, he worked as a Czech securities market regulator in the Czech Ministry of Finance, where he led the financial services work during this first Czech presidency of the European Council. Jiří also spent several years at the European Commission working on the regulation of markets in financial instruments Directive MiFID, implementing measures and coordinating the Commission's policy towards the Financial Stability Board and the G20. He studied international relations, economics, and politics at Tufts University, London School of Economics, and Sciences Po. Jiří, please join me. There's the remote control.
Thank you. Hello, everyone. So just a brief intro to AIMA and what we do. For those who might not know us, we're an association representing alternative investment managers. That includes both liquid alternatives like hedge funds as well as private markets alternatives, where we focus on private credit mainly. So the Alternative Credit Council blue logo, that's something that I founded back in 2015, which is our private credit arm. So trying to cover all the, or as many of the alts strategies as possible. And what I'll do today is talk a little bit about the growth and performance experience and expectations, and then highlight some interesting themes that I think will be driving the future of alternatives. So this is the past and the future expectation of the growth of the various alternative subsectors, from hedge funds through private credit, private equity, and real estate. And you can see that it's been a fairly decent experience. Private credit recently is probably the fastest growing asset class. It's been growing roughly 20% a year. And we expect it to double in the next 3 to 5 years again. So going from 1.5 trillion today roughly to about 3 trillion soon enough. And hedge funds are also doing well, and I'll talk about how that's sometimes overlooked. But overall, the sentiment is pretty good, because the performance is good. And it's expected to be good going forward. You have a growing investor sophistication and, crucially, size. So investors, that size has multiple types of impact in terms of what people want and why they want alternatives. And what is driving private markets in particular is the size of the investors now such that oftentimes participating in public markets makes no sense for them, right? Because public markets for them means I cannot move as much capital as I'd like to within public markets because the liquidity is too low. And so therefore, I'm effectively a buy and hold long-term investor. So if I'm going to be a buy and hold long-term investor, I might as well invest in some of the private assets and collect either a control premium, complexity premium, or liquidity premium, whatever it is, but you're likely to get a better deal. And then the retrenchment of the banking sector is probably one of the biggest ones in terms of the drivers of private credit. And that's going to be an ongoing trend, especially here in Europe, right? Because Europe is so bank heavy, and it's well on its way to transition away from the bank-centered financial model. And it's not just in corporate lending and real estate, it's all forms of asset-based finance. Asset-based finance, we estimate, is today something along the lines of 5 trillion globally. It's likely to grow to 7 trillion in about 3 years. So something that oftentimes people overlook when they look at private credit as an asset class. So here is just a small kind of sample of what's been happening that shows you why alts have been doing well. This is the allocation from public pension schemes. Why we have, or why I like to use this data, because it's fairly accurate. You can get it from those schemes because they have to provide it as they are public institutions. The problem with data in the alternative sector is immense in terms of just trying to measure basic things like what is the size and performance of these things. And so it's good to use this kind of data because it gives you a fairly accurate picture. And you can see that there was a 10% increase between 2017 and 22 in the allocations to alternatives. And the performance has also been pretty interesting, right? In terms of public versus private markets, the difference is incredible, right? Almost double, right? And then when you look at the liquid alts, the hedge fund bit, which is, I think, the true sort of alternative, 6% doesn't look as stellar compared to the private side of things. But if you look at, let's say, non-US stocks and hedge funds, roughly performing the same way. And non-US stocks, I think, is a better feel for what equity risk is like, because US stocks, as we all know, in the last 10 years was, a handful of companies that were driving these returns, and so not necessarily a fair representation of the overall equity market risk that people bear. So a pretty good number, but not everybody gets those averages, right? And this is the big issue for investors. How do you, first of all, find a manager that performs well and is likely to have persistent performance? And number two, how do you actually get the manager? How do you get to invest with them? And number three, how do you get to invest with them on decent terms, right? Those three problems are going to plague investors for the foreseeable future, and are going to be something that also will drive some of the trends that I'll talk about later on. This is just another look at the dispersion in the private equity space. So again, you see performance overall improving for the various vintages, but also the dispersion growing ultimately. In the liquid markets, the good news, and we heard that in the previous presentation, hedge funds are back, so to speak. There was a period of lackluster performance that has, we think, subsided. But again, this is looking at data that is publicly available. So the data that is reported by hedge funds to public databases, right? Look at this graph. So the non-public funds, the red line is the funds that do not report to public databases. And this is data that's obtained from the regulatory filings. So the stuff we don't see because the regulators don't publish it, apart from when they do these studies. And what you can see is that actually hedge fund performance, although there was that sort of moment of stagnation, have not done that badly. So the experience of the investor is different than what you may have read in the papers overall. But the problem of dispersion is the same. So 40%, right, spread between the 10th and the 90th percentile. So the same issue presents itself in the hedge fund world and the liquid alternatives world as in the private markets world, right? So that gives us the trend number one. Really, the investors want to be able to understand performance and compare performance, measure it better. That's tough, and I think it's been attempted a number of times by industry initiatives, but now it's gotten to a point where the investors are reaching out to the regulators, right? And as I said, this means that the regulators are starting to listen, and the US is at the forefront of this, and they're trying to impose measures of performance, but also equal treatment of investors, right? So they're trying to use law to basically say, number one, you're going to have to disclose performance in exactly the following manner that we will prescribe for you. And number two, you're going to have to give all investors equal access, right? Which could be a problem, because the unequal access, in a way, that a lot of the managers give to investors is a function of effectively the size, you can boil it down to that, of the investment that you get. So it's basic microeconomics, right? It's price differentiation. It's you buy your airplane ticket a day before your departure, you're going to pay more. You spend time and resources on researching it and do it well in advance, you can get something cheaper. So that's a beneficial thing for the economy and leads to optimal output, if you will. But what the regulation is trying to do is to harmonize everything. But what will happen is that you'll have a harmonized product which is going to be relatively more expensive on average for everybody. And then you're going to still have the super large investors who are going to get the very beneficial boutique one-on-one treatment. And so this risks actually backfiring for the overall investor community. But again, I don't think that will stop the trend of growth. Partially also because I think there's going to be enough of a pushback, but this is going to be persistent sort of underlying driver in terms of the debate between managers and investors. Then what we have is really a massive entrance of retail investor community into this space, and this is primarily in the private market space, but not necessarily only in that space, because we also had the typical retail products like UCITS being modernized, but recently 40 Act funds, but also Canadian funds that allow for hedge fund strategies to be distributed. The problem in Europe is that, again, we've got more, as we've discussed, more apprehension by regulators around all the alternatives, right? And so even though the one foot is on the gas pedal, the other foot is still very much on the brake. And the focus so far has been, and the way to do this and get more retail access has been under this guise of, hey, we want retail to fund the future transition of the towards a low carbon economy, investment in infrastructure and all that. So a number of new vehicles have been now introduced, and we discussed LTIF. In the UK, it's the LTAF. And as I said before, in the US, it's the BDCs. The issue with retail participation is that it's always extremely tricky and politically dangerous, because anything happens, any problems there are going to lead to backlash and are going to potentially lead to more regulation, tougher regulation, and not just for retail overall. And so for us as an industry body, it's clearly a challenge in terms of driving good behavior and driving sound practices, which is what we focus on. Final trend I want to discuss that drives the rise of alternatives, in particular private debt in Europe and globally, is this disintermediation trend. And the disintermediation is actually sort of broader, and I'll just focus on an example of banking, right? Where today's regulatory environment allows every single bit of the banking service be provided by a non-bank under a special license. So you could take and assemble a bank today by having a private credit manager on the lending side, a money market fund as a sort of a deposit-like product, a payment services provider in the middle, and a little broker-dealer sitting there allowing for capital markets activity and investment banking, right? So that can be nicely decomposed and is decomposed already, and obviously is growing. And you can see that this is partially a result of bank regulation, but also a result of the banks effectively drastically simplifying their business models, right? So you can see that in the hedge fund world, where we are now serving effectively as a bank balance sheet. Hedge funds, relative value hedge funds, own close to $1 trillion US treasuries, right? They've been sort of the off-balance sheet of the banking industry. Private credit managers, as I said, they're the lenders to corporates increasingly, right? And in terms of securitization, for example, in the United States, this is almost entirely asset manager-driven activity, right? So the various verticals of both the sort of the lending, holding and financing of governments and government debt, as well as various capital market activity like underwriting, are being increasingly and in the sort of majority done by the asset manager industry, right? And the U.S. is clearly the leader here, this latest episode of banks, failing in their management of the various mismatches means that that's going to get deeper. And we see, I think Blackstone recently said they just raised some 20 billion or 30 billion of capital for a real estate lending fund, like overnight almost, right? 30 billion, that's not a small number. In Europe, it's going to be progressing, maybe not as fast, but definitely progressing there. And what is interesting in Europe, and where Europe has an edge, is in the area of digital assets and digital assets regulation, right? Because in the US, there's a huge attack on the digital assets industry at the moment. Politically, they're being sort of driven out of existence for various reasons. There is a refusal to recognize that space requires sort of sui generis regulation and regulatory treatment. But the Europeans have already taken steps to actually recognize that there's the need for a specific regulation. And so it will no longer be this kind of half shady, half criminal type of activity. It will be properly, fully licensed, fully regulated activity. And at the core of some of the digital assets project is disintermediation. So you can see it in terms of, let's say, exchanges, right, where you have decentralized finance and people basically trade on the basis of an algorithm that's released out in the wild, right? There's nobody sort of governing that. You can see it in terms of lending, and you could go on. And so coupling these trends that were started already a long time ago, if some of the digital assets providers or inventors can sort of successfully integrate into the regulated financial industry, you could see this revolution going much further in Europe and much quicker in Europe. And that also means, large participation by asset managers in this. So the growth will continue. You will see more, investors coming online as this becomes much more broad-based. Private credit is great because we saw from 5 years ago where this was an opportunistic strategy. Now, most of the large investors have a dedicated private credit bucket, so it's an asset class of itself, and that just happened in the space of 5 years, so it's amazing. And at the same time, as I said, that growth does attract policymaker interest, and so there will be a sort of a regulatory reaction, which we're witnessing at the moment. The EU has been working on actually capturing this trend in the asset management space. So both AIFMD and LTIF, we discussed, those directives and regulations are being updated, and they are going to boost the sort of the internal market component. So it's going to be, for example, easier for funds to lend on a cross-border basis. It's not really easy today to lend from Luxembourg to Germany for a fund. Same thing for Luxembourg to France, right? After this AIFMD reform, that's going to be possible without any additional licensing. And so I like to liken that to the transition sort of away from fossil fuels, where you had a particular model of operating to more of a, let's say, renewables. We're all producing the same kind of thing, energy on one side, finance on another, but the modes of production are going to change, and the asset managers are going to be part of that, and the investors will be able to directly participate in this, as opposed to being indirect participants or forced participants by either holding bank deposits or buying debt or equity of the banks who are the main actors here. So those who do not move quickly here will be left behind, as is always the case. But the good news overall for the economy is that what we see is, as your capital market or non-bank finance component of the financing mix grows, so does economic growth. And that's been demonstrated on large data sets, including using our studies on European Union as well. So hopefully we've got a bright future to look ahead.
Thank you very much.